Did you know that the average American with a credit card is paying over 22% interest right now? That is not a typo. 22.7%, according to the Fed's April 2026 Consumer Credit Report. Meanwhile, the same Federal Reserve that made your credit card a nightmare just signaled something huge last week. Jerome Powell stood at the Jackson Hole podium and said, quote, "The balance of risks has shifted." Wall Street heard one thing: rate cuts, coming faster than anyone expected. And if you are not positioned for what happens next, you are about to watch the wealthy get a whole lot wealthier while you stand on the sidelines wondering what hit you. Here is the take that will make the personal finance gurus angry. Your 401k is not a wealth-building tool. It is a retention mechanism designed to keep you loyal to an employer while earning mediocre returns inside a target date fund that is stuffed with bonds that are about to get crushed. I said it. The target date fund for 2050 in most plans is still holding 30% in fixed income. In a rate cut environment, long-term bonds actually go up, yes, but the problem is the reallocation lag. By the time your HR department rebalances, the move will be over. You need to take control right now, before the first cut hits in June. Let me explain the mechanism, because most people get this backwards. When the Federal Reserve cuts the federal funds rate, which is the interest rate that banks charge each other overnight, two things happen immediately. First, money becomes cheaper to borrow. Second, existing fixed income assets with higher yields become more valuable. Think of it like this. Imagine you bought a bond last year paying 5%. Suddenly, new bonds are only paying 3%. Everyone wants your old bond. Its price goes up. That is the bond rally. But the real money is not in bonds. It is in assets that get repriced for lower discount rates. Growth stocks, especially tech companies that are expected to generate most of their cash far in the future, become much more attractive because you are discounting those future earnings by a smaller number. That is why the NASDAQ historically explodes in the 12 months following the first rate cut. Also, small caps benefit because they carry more floating rate debt. Lower rates mean lower interest expenses, higher profits. That simple. Play A. Low risk, under $500. Buy the Vanguard Small Cap Value ETF, ticker VBR. Current price as of this morning is $187.40 per share. Your entry target is anything under $190. Stop loss at $170. Catalyst date is the June 11th FOMC meeting, where the first 25 basis point cut is now priced at an 82% probability, according to CME FedWatch as of April 3, 2026. VBR has an expense ratio of just 7 basis points and holds 841 stocks. You are diversifying across small American manufacturers, regional banks, and energy companies. Why value instead of growth? Because small cap value has historically outperformed small cap growth by 4% annually over the last 50 years in falling rate environments. Put $200 in today. Add $100 every month. Do not touch it for 18 months. Play B. Medium risk, $1,000 to $10,000. Buy the iShares 20-plus year Treasury Bond ETF, ticker TLT. I know, bonds are boring, but listen to the setup. TLT is currently trading at $92.15. That's down 40% from its 2020 peak because rates rose so fast. If the Fed cuts by 100 basis points over the next 12 months, which is the current median dot plot projection from the March 2026 SEP, TLT should rally to at least $110. That is a 19% gain plus the 4.1% dividend yield. Your entry is anything below $95. Stop loss at $85. But here's the pro move. Do not just buy TLT. Sell a put credit spread. Sell the $90 put and buy the $85 put for a net credit of $150 per contract. That gives you downside protection and collects premium. If you don't know options, just buy the ETF. But know that the bond market is screaming. The 2-year Treasury yield just fell below the 10-year yield by 40 basis points. That is not normal. That is the bond market telling you the Fed is behind the curve. Play C. Higher risk, aggressive growth. Buy MicroStrategy, ticker MSTR. I can hear the comments already. Crypto is gambling. No. This is a corporate treasury play. MicroStrategy holds 226,000 Bitcoin as of their April 1st filing. But here's why rate cuts matter. Lower rates weaken the US dollar. Bitcoin is priced in dollars. A weaker dollar means higher Bitcoin price. But more importantly, MicroStrategy has over $2 billion in convertible debt that pays near 0% interest. When rates fall, that debt becomes even cheaper to roll over. They can issue more converts, buy more Bitcoin, and create a feedback loop. Current MSTR price is $1,420. Entry target $1,300 to $1,450. Stop loss $1,100. Catalyst date is the Bitcoin halving's full effect, which historically takes 12 to 18 months, putting us right in the sweet spot for November 2026. But I'll be honest with you, this is volatile. Do not put more than 5% of your portfolio here. Here is where most of you will fail. Right now, you're excited. You want to go buy all 3 plays immediately. That is recency bias. You are extrapolating the current feeling of opportunity into the future. But the real money in this setup will be made not in the first month after the rate cut, but in the 7th and 8th months when everyone else has gotten bored and sold. The average retail investor holds an ETF for only 6 months. 6 months. That is not investing. That is gambling with extra steps. The second trap is loss aversion. When TLT drops $2 from 92 to 90, most of you will panic sell because you heard bonds are supposed to be safe. But bonds fluctuate. A $2 drop on a $92 ETF is nothing. That's 2%. Yet studies show that retail investors feel the pain of a 2% loss twice as strongly as the pleasure of a 2% gain. You will sell the bottom. I have seen it happen in March 2020 and June 2022. Do not be that person. Set your stop loss, then walk away. Do not check the price every hour. Check it once a week. Let me take you back to 1995. The Fed, under Alan Greenspan, cut rates by 75 basis points starting in July. The NASDAQ proceeded to rally 120% over the next 2 years. But here's the part nobody remembers. In the first 30 days after the first cut, the NASDAQ actually fell 3%. People panicked. They said the cut was a signal of recession. They sold, and then they missed the entire bull run. Same thing in 2019. Powell cut rates in July. The market dropped 6% over the next 3 weeks on trade war fears. Then, from August to February, the S&P 500 ripped 40%. The pattern is always the same. Sell the rumor, buy the fact? No. This time, it is buy the rumor, panic sell the fact, then chase the move 6 months later. Do not chase. Position now and sit. Here's the political piece that no YouTuber is talking about. The Federal Reserve is under immense pressure from the Treasury Department because of the national debt. As of April 2026, the U.S. government is paying over $1 trillion annually just in interest on the debt. That's more than the entire defense budget. Every 25 basis point cut saves the government roughly $60 billion per year. Secretary Yellen has been privately pushing Powell to cut faster. And Powell, who was renominated by Biden and then kept by the next administration, is a Republican who cares about his legacy. He does not want to be the Fed chair who crashed the economy. But here's the new regulation coming. The Basel III endgame capital requirements for regional banks are set to go into effect July 1st. Those rules force banks to hold more capital against long-term bonds. That means banks will sell bonds into any rally. That caps the upside on TLT. So your bond trade works, but only until June 15th. Get out by then. This trade looks completely different depending on where you live. In Texas, where energy prices and housing are still running hot, the rate cut will actually accelerate inflation in Dallas and Houston. That means the Fed might pause after just 2 cuts. So your small cap value play works, but you need to overweight energy names inside VBR. In New York and California, commercial real estate is the story. Lower rates will rescue office landlords from floating rate debt maturities. That is bullish for Vornado and SL Green, both held inside VBR.
In Ohio and Pennsylvania, manufacturing gets a boost from cheaper borrowing costs. The regional divergence is real. Comment your state below, and I will tell you which factor matters most for you. Bitcoin dominance just hit 54% on April 2nd. That is the highest since 2021. Why? Because smart money is rotating out of speculative altcoins and into the hardest asset before rate cuts. But the correlation is even tighter than you think. Every time the Fed pivots from hiking to cutting, the M2 money supply growth re-accelerates. M2 just turned positive year over year for the first time since October 2024. Bitcoin has a 70% correlation with M2 growth over a 12-month lag. That means the November 2026 Bitcoin price is likely 40 to 60% higher than today. That puts Bitcoin between $110,000 and $130,000. Do not chase altcoins, just buy Bitcoin and Ethereum in a 70-30 split. Before you deploy any of these trades, check your own balance sheet. Credit card delinquencies hit a 12-year high in March 2026 at 4.3% according to the New York Fed. Auto loan delinquencies are at 5%. If you are carrying high-interest debt, paying that off is a guaranteed return of 20%. Do not invest a single dollar until your credit card balance is zero. I'm serious. The best trade you can make is becoming debt-free. Then and only then should you buy VBR or TLT. But wait, someone is going to comment, what if the Fed doesn't cut because inflation comes back? Fair question. Let me address it. The Cleveland Fed's inflation nowcast for April 2026 is 2.1% headline and 2.3% core. That is below target. The labor market just added only 120,000 jobs in March. That is weak. The Fed has a dual mandate. Employment is flashing yellow. They will cut even if inflation is at 2.5% because the alternative is a recession. The counter-argument that inflation reignites only works if oil spikes to $120. That is possible but not probable with OPEC Plus increasing production in June. Here's a legal tax loophole you can use right now. If you buy TLT in a taxable brokerage account and rates fall, the ETF will pay out capital gains distributions in December. Those are taxable. Instead, buy individual Treasury bonds directly at Treasury Direct. They don't pay capital gains distributions. You only pay tax when you sell or when they mature. And if you hold to maturity, you pay no state or local tax. For a New York or California resident in the top bracket, that saves you over 13%. Alternatively, put your bond allocation inside a Roth IRA. Then all gains are tax-free. That's the pro move. Here's your challenge for today. Take $50, not $500, $50, and buy one share of VBR before tomorrow's market close. Just one share. That's it. See how it feels to own a piece of 841 American small businesses. Write in the comments the word "done" when you do it. Before you do any of this, you need 3 to 6 months of expenses in a high-yield savings account, not in VBR, not in TLT, not in crypto. Cash, earning 4%. That's your sleep-at-night money. If you don't have that, close this video and open a savings account first. But here's the thing about rate cuts that I haven't told you yet. The first cut is not the most important one. It's the third cut. And when that third cut happens, a completely different set of assets will explode. That's exactly what we're covering in Chapter 2, the AI Bubble 2.0. Not NVIDIA, but the energy and data center plays that every institutional investor is quietly accumulating. Hit like right now. Subscribe with notifications on. Comment your state so I know where you're watching from. Everyone is obsessed with NVIDIA. The stock is up 500% since 2023. Every YouTuber is telling you to buy the dip. But here's the dirty secret that Silicon Valley doesn't want you to know. NVIDIA's chips are useless without two things: electricity and physical buildings to house them. And right now, America is running out of both. The Department of Energy just released an April 2026 report stating that data-centered power demand will triple by 2030. That's the equivalent of adding another California to the grid. But the grid is not ready. Transformer lead times are 5 years, substations are backlogged, and the REITs that own the land, the power contracts, and the cooling infrastructure are trading at single-digit price-to-earnings ratios, while NVIDIA trades at 40 times. The rotation has already started. You just are not looking in the right place. Here's the take that will get me banned from tech Twitter. NVIDIA is not a long-term hold at this price. It's a trade, a beautiful, magnificent, life-changing trade if you bought it 3 years ago. But today, the risk-reward is broken. Why? Because hyperscalers like Microsoft, Google, and Amazon are already designing their own AI chips. The margin compression is coming. It always does. The real moat in AI is not the chip. It's the power purchase agreement, a 20-year contract to buy electricity at a fixed price from a nuclear or geothermal plant. That's the new oil well. And the companies that own those contracts are trading like utilities, not tech stocks. That's the mispricing of 2026. Let me break down the physical reality of AI. A single ChatGPT query uses 10 times the electricity of a Google search. Now multiply that by billions of queries per day. Training a large language model like GPT-6 consumes over 1,000 megawatt hours. That's the monthly electricity usage of 100 American homes. So where does all that power come from? Right now, natural gas peaker plants, but those are dirty and expensive. The shift is toward behind-the-meter generation, meaning data centers building their own power plants on site, nuclear, geothermal, and natural gas with carbon capture. But even before you generate the power, you need the real estate. Data center REITs buy land near major fiber optic hubs and substations. They build the shell, they install the cooling, they rent the space to hyperscalers on triple net leases. Those leases have rent escalators of 3 to 5% per year, and because demand is exploding, occupancy rates are at 98% across the primary markets: Northern Virginia, Dallas, Phoenix, Columbus. That's where the money is.
Play A. Low risk, under $500. Buy the Digital Realty Trust preferred shares. Ticker DLR.PRK. Preferred shares are boring. That is why they work. Digital Realty is the largest data center REIT in the world. Their common stock trades at $140. That is too expensive for small accounts. But the preferred shares trade at $24.50 and pay a 6.8% dividend. That is a fixed dividend that resets every 5 years based on the 5-year Treasury. With rates falling, the reset will likely go down, but the price of the preferred will go up because the spread over Treasuries widens. Current yield to worst is 7.2%. Your entry is anything under $25. Stop loss at $22.50. Catalyst date is the June FOMC meeting because preferreds are interest rate sensitive. But unlike common stock, preferreds have a liquidation preference. If Digital Realty goes bankrupt, which it will not, you get paid before common shareholders. That is safety. Play B. Medium risk, $1,000 to $10,000. Buy Vistra Corp. Ticker VST. Vistra is not a REIT. It is an independent power producer that owns a massive fleet of natural gas, nuclear, and solar plants in Texas and the Midwest. Here is the AI connection. Vistra just signed a 20-year power purchase agreement with an unnamed hyperscaler to supply 300 megawatts to a new data center outside of Dallas. The contract has a fixed price of $55 per megawatt hour. Current wholesale Texas electricity prices are volatile but average $40. That seems like a bad deal until you realize that Vistra is locking in revenue while their competitors are exposed to price swings. More importantly, Vistra owns the Comanche Peak nuclear plant. Nuclear runs 24/7. It is carbon-free. It is perfect for AI. Analysts at Goldman Sachs just raised their price target from $85 to $110. Current VST price is $76.20. Entry target, 70 to 78. Stop loss at 65. Catalyst date is the Texas summer. When heat waves hit and prices spike, Vistra's unhedged merchant plants print money.
That cash funds the dividend, which is currently 2.1%, but growing. Play C. Higher risk, aggressive growth. Buy Algonquin Power and Utilities, ticker AQN. This one is controversial because Algonquin has had accounting issues and cut its dividend in 2024. But hear me out. They own wind and solar farms that are co-located with data center development sites in Virginia and Illinois. Their regulated utility business provides stable cash flow. The unregulated renewable business is the growth driver. AQN currently trades at $4.90. That is down from $15 in 2022. The market has given up. But activist investor Starboard Value took a 10% stake in February 2026 and is pushing for a breakup. Sell the regulated utility to a private equity firm, spin out the renewables, unlock value. The sum of the parts valuation is $9 per share. That is nearly double. Entry target, $4.75 to $5.10. Stop loss at $4. Catalyst date is the August shareholder meeting, where the breakup vote will be announced. This is not for the faint of heart. You could lose half your money, but if it works, you double. Here is the trap specific to AI infrastructure. Most retail investors look at Vistra and say, that's just a utility. It's boring. It will never go up like NVIDIA. That is anchoring bias. You are anchoring to NVIDIA's 100% annual returns. But Vistra is up 40% year-to-date in 2026. 40%. That is not boring. That is beating the market by 3 times. The second trap is familiarity. You have heard of NVIDIA. You have not heard of Algonquin. Your brain tells you that familiar means safe. That is false. Enron was familiar. Lehman was familiar. Familiarity in finance is a marketing expense, not an investment thesis. The institutions moving into Vistra and Digital Realty are not dumb. They are the same firms that bought NVIDIA at $20. They are rotating because the easy money in chips is made. The hard money in power is just starting. Go back to 1999. Everyone was buying Cisco, the routers, the switches, the backbone of the internet. Cisco went up 10,000%, then it crashed 80%. But here is what nobody remembers. The companies that owned the fiber optic cables, the data centers, the power lines, those companies did not crash as hard. Equinix, which is a data center REIT, went public in 2000 at the peak. It fell 50%. Then it took 10 years to recover. But if you held from 2000 to 2026, you're up 2,500%. Cisco is still below its 2000 high. The lesson is clear. Picks and shovels are good, but the land under the picks and shovels is better. The Department of Energy just released a proposal called the Grid Resilience and Innovation Partnerships Program, GRIP 2.0. It allocates $10 billion for data center interconnection. But there's a catch. To receive the funds, data centers must use union labor and pay prevailing wages. That's driving up construction costs. That actually benefits existing REITs because new entrants can't compete on price. The bigger regulatory story is the Federal Energy Regulatory Commission, FERC. FERC just passed Order 2026, which forces grid operators to process interconnection requests within 6 months instead of 3 years. That's huge. It means new data centers can come online faster. But it also means oversupply risk. Too much supply kills pricing power. That's why you want the REITs with signed leases, not speculative development. Digital Realty has 97% of its 2026 capacity already leased. That's the moat. Virginia is the data center capital of the world. Loudoun County alone has over 30 million square feet of data center space. But Dominion Power just announced it can't connect any new data centers until 2029 because the transmission lines are full. That's a disaster for new projects, but a gift for existing landlords. Digital Realty's Virginia portfolio just saw asking rents increase by 20% year over year. In Texas, the story is different. ERCOT, the grid operator, has no capacity constraints, but they have price volatility. That benefits Vistra. In Ohio, Intel is building a $200 billion chip factory. The surrounding data center land has tripled in value. The regional play is simple. Buy the REITs with exposure to constrained markets. Avoid the ones betting on new grid connections. Bitcoin miners are essentially data centers for proof of work, and they're pivoting to AI hosting. Core Scientific, ticker CORZ, just signed a deal with CoreWeave, an AI compute provider, to convert 30% of its mining capacity to AI. The market hasn't priced this in. CORZ trades at $3.50. Book value is $4. That's a discount. But here's the crypto twist. When Bitcoin price goes up, miners make more money. When AI demand goes up, miners make more money from hosting. It's a dual catalyst. The risk is that Bitcoin price crashes to $30,000. That would force miners to sell their Bitcoin holdings and dilute shareholders. So don't go all in, but a small allocation, say 2% of your portfolio, makes sense. Data center REITs are capital intensive. They borrow money to build buildings. As of April 2026, Digital Realty has $14 billion in debt. Their weighted average interest rate is 4.3%. If the Fed cuts rates, they can refinance at lower rates, which boosts earnings. But if the Fed doesn't cut, or if credit markets freeze, that debt becomes a problem. The warning is this: do not buy these REITs on margin. Do not use borrowed money. The dividend is not guaranteed. In 2023, several office REITs cut dividend to zero. Data centers are different, but they are not immune. Keep your position size reasonable. But wait, the skeptic says, what about the efficiency gains? AI chips are getting more efficient each generation. Blackwell is twice as efficient as Hopper, so power demand won't triple, it will flatten. That's a great point. Let me answer it. Jevons paradox. When a resource becomes more efficient, you use more of it, not less. Cheaper gasoline led to more driving. More efficient chips will lead to more AI models, more queries, more training runs. The efficiency gains are real. They lower the cost per query. That expands the market. Total power demand still goes up. The Department of Energy's report factored in efficiency gains and still got tripling demand. I trust the DOE over a Twitter skeptic. If you buy Digital Realty common stock, you will receive a 1099 DIV each year showing ordinary dividends, qualified dividends, and return of capital. The return of capital portion is not taxed immediately. It reduces your cost basis. When you sell, you pay capital gains on the difference. That's a tax deferral. For high-income earners, that's valuable. But here's the better hack. Buy the REIT inside a Roth IRA. Then all dividends, including the return of capital, are tax-free.
Before you buy any of these plays, check your emergency fund again. Data center REITs are not liquid. If you need money next week, you will be selling at a loss. The bid-ask spread on the preferreds can be wide. Only buy what you can hold for at least 1 year. And never put more than 10% of your net worth into any single sector. You have just learned about the energy and real estate behind the AI bubble, but there is an even bigger, more terrifying force moving in the shadows. The United States government is $34 trillion in debt, and in Chapter 3, I'm going to show you exactly what happens when the credit rating gets downgraded again. It is not what you think. Gold miners and muni bonds, that is the trade. Subscribe, hit the bell, comment the word power if you understood the data center thesis.